Welcome back to another edition of the Blue Chip Partners Quarterly Edge. For the first quarter of 2024, we decided to try something a little bit different. And so Dan Seder, managing partner here at Blue Chip Partners, has a few questions to ask me regarding my equity market, fixed income market, and overall economic outlook for 2024.
Daniel, thank you. So the economy in 2023 was resilient. Talk to us about the economy moving forward into 2024.
Yeah, I think resilient is the name. I mean, I don't think anyone on the sell side in the investing public really expected the level of growth and just overall resiliency that we saw this year. As we look towards 2024, I do think it's a year of transition for a number of reasons. Number one, the Federal Reserve transitioning. Number two, the Federal Reserve looking more at the labor market instead of solely focusing on inflation, which is structurally in a downward trend. I think the labor market and the consumer are the two most important pieces of the puzzle for 2024. Specifically, when we look at the labor market, there has been some signs of softness emerging. The level of jobs added on a monthly basis is in a downtrend. The wage growth, average hourly earnings, is in a yearly downtrend. And I do think that this continues, which can provide a little bit more softness on the consumer side of things.
So there's a lot of talk about the Fed possibly threading the needle and producing a soft landing. Is a soft landing off the table?
Absolutely not. Actually, it's what the market's pricing in right now as a base case.
Okay.
And I'm not here to debate whether or not that comes to fruition. But all I'm saying right now is that 2024, to me, feels like a year of slower growth. And let's be very clear, that's not no growth. That's not negative growth. That doesn't mean recession. But I do think after a period of very robust growth, the signs are all pointing towards a period of slowdown.
Sure. It just can't keep going at a robust pace forever.
Absolutely.
Right. So how does that translate into equities? It's been a relatively narrow market. Can you talk a little bit more about the stock market and what we've seen in 2023 and what that could mean in 2024?
Yeah, you hit the nail on the head. I mean, narrow market is probably the understatement of the year.
Yeah.
We had 7 stocks, your magnificent 7, that contributed nearly 65% of the return in the S&P 500 index. When you look at the S&P 500 cap-weighted index, which is the traditional S&P 500, relative to an equal-weighted version of that same index, the return spread between the two was the largest it's been in favor of the S&P 500 cap-weighted since 1998. You also had the lowest number of stocks within the index that actually beat the index since, again, 1998. So just absolutely narrow. If you were involved in those 7 stocks, kudos to you. But realistically, 2023 was more of an outlier instead of being the norm. As we look towards 2024, we've already started to see some of this in the fourth quarter of 2023, but I really do anticipate a broadening out of equity market performance. So in light of what I said economically, I don't necessarily think it's setting up to be a banner year. I do think that you have to be selective. Just as we talked about last quarter, there are certain types of companies that tend to perform better in the slowdown phase of the economic cycle. Those are companies with really good balance sheets, fair amount of cash on hand with low leverage, and that are returning cash to shareholders. So I do think that those are some of the names that have inadvertently been left behind in 2023. And as we look at 2024, even sectors like utilities poised for some really nice earnings growth. And I think that you can get some of that broadening out reflected in some of the sectors and industries that were left behind in 2023.
Makes sense. And it actually plays well into the blue chip strategy for how we manage stocks. So that's good to hear. Daniel, on a final note, bonds. The bond market has rallied, and it's been after a relatively unprecedented sell-off in bonds as interest rates started to rise. What are you seeing in bonds? What types of bonds? What's the outlook for bonds going into 2024?
I continue to be very optimistic on your traditional high-quality subset of the fixed income market. So if you'll recall, over the last 6 months, I really have been recommending that investors pare back those money market allocations,
right,
which can be a nice little asset to have when they're paying you 5 to 5.5%. But all history would tell you that now is the time to start tapering off that money market allocation and push the proceeds into the traditional fixed income market. I'm talking about treasuries, investment grade corporate bonds, and municipal bonds for those which it's beneficial. And even after we saw a fairly significant rally in the bond market to close 2023, you still have yields across that subset that are higher than 70% of the time over the last 20 years. So I do think that you're locking in a really nice coupon. And realistically, on a risk adjusted basis, you're getting a good value proposition. You take a little bit more risk, but you're rewarded for it by way of higher coupons. And there's great potential for price appreciation over the next couple of years as well. And just to kind of close the loop on this, yes, we have the Federal Reserve that is by and large expected to cut next year, cut interest rates, and become overall more stimulative. I don't necessarily think we're going to get the 6 rate cuts that's priced into the bond market right now, or I should say is expected by Fed funds futures right now. But even if that's not the case, I do think the value proposition is good, and overall lower volatility in rates is going to be a good thing for these attractive income bearing assets.
Yeah, it sure feels like we're at least at the end of the hike phase. As they pause, the Fed has said 3 rate cuts. The bond market is pricing in 6. It certainly seems like it's not likely to go higher. I mean, to be determined, but at least that's what we're hearing and seeing from the numbers today.
Yeah. And in all reality, I'm not saying that it's time to shift your stock market allocation or a portion of your stock market allocation to the bond market. I just think people need to be fully invested in the bond market because now is the time to move before the Fed actually cuts, just as we touched on last quarter.
Yeah. Well, fantastic. Thank you for clarifying. This was a lot of fun.
Happy to do it. Always a good conversation, Dan.